You know how sometimes you stumble upon a fact that just clicks, completely changes how you see something, or offers a shortcut to truly understanding a complex topic? That's the feeling we're chasing today as we unravel a fascinating corner of finance that often feels, well, a bit like a mystery. Today, we're taking a deep dive into how a company's financial limitations, what we call financial constraints, don't just affect its operations, but can profoundly impact its stock returns and overall risk profile. And the insights we're about to share might just surprise you.
And our guide for this deep dive is a really insightful paper, Financially Constrained Stock Returns, published in the Journal of Finance back in 2009 by Dmitry Livdan, Horacio Saprissa, and Lu Zhang. This paper is kind of a breakthrough because it doesn't just offer new insights, it helps finally reconcile a long-standing puzzle in financial research.
A puzzle? That sounds intriguing. What exactly were researchers grappling with that made this paper so critical?
Well, the puzzle was this. Earlier studies on financially constrained firms presented conflicting evidence. On one hand, some research suggested that these firms, the ones struggling to raise capital, actually earned lower stock returns.
Right, which kind of makes intuitive sense, doesn't it? If a company can't get money, it's likely struggling, maybe its stock performs poorly.
Exactly, that was the intuition. But then other studies hinted at higher returns for these very same types of firms. But crucially, without a clear, universally accepted explanation for why that would be the case, it was a contradiction. It really needed a robust theoretical framework to make sense of it all.
So Livdan, Saprissa, and Zhang stepped into that void. And their model, if I understand correctly, provides a framework that actually leans into the idea of higher returns.
Precisely. Their model provides a robust framework showing that, contrary to some initial intuitions, more financially constrained firms are actually riskier. And as a result, they earn higher expected stock returns than their less constrained counterparts. And the why behind it, the underlying mechanism, is truly insightful. It's surprisingly elegant once you unpack it. It really hinges on how these constraints fundamentally alter a firm's ability to navigate economic ups and downs.
Okay, so our mission today is to guide you through this complex but really crucial topic. We'll explore the underlying mechanisms, unveil some surprising facts, and discuss what it all means for understanding how companies operate and how their stocks truly perform. Let's start by getting our foundational terms absolutely clear. Okay, let's unpack this crucial first step. Before we get into the nuts and bolts of the model and all the, financial engineering involved, we need to clarify some terminology that often gets mixed up, maybe even by seasoned professionals. Financial constraints versus financial distress. They sound similar, and they are undoubtedly correlated, sure. But in the rigorous world of financial research, they're distinct concepts with very different implications. And this paper specifically focuses on one over the other.
That's right. And getting this distinction clear from the outset is really vital for understanding the paper's contribution. So when we talk about financial constraints, as defined by researchers like Lamont, Polk, and Sarakejo back in 2001, we're referring specifically to frictions that prevent the firm from funding all desired investments. And this is a key distinction. It's important to stress here that this isn't necessarily about a company being in deep trouble or, on the brink of collapse.
So it's not quite a crisis, but more like a missed opportunity, like they can't reach their full potential.
Exactly. Instead, it's about limitations on a firm's ability to capitalize on growth and opportunity, even if those opportunities are genuinely promising and potentially very profitable. Think of it like a world-class athlete, incredible natural talent, huge potential, fantastic opportunities to excel, maybe even Olympic level. But they simply lack the financial resources to afford the best coaching or the top-tier equipment or that specialized training they need. This athlete isn't injured, they're not performing poorly, they're just held back from reaching their peak performance because of these external limitations on financing.
I like that analogy. So they have the talent, they see the path to gold, maybe, but they just can't afford the resources to actually get there.
Precisely. In a corporate context, this inability to fund desired investments could stem from various factors. Difficulty in borrowing additional funds, maybe due to strict credit market conditions, or maybe a perceived lack of good collateral, or maybe an inability to issue new equity without incurring prohibitively high costs, or maybe a heavy reliance on just a few bank loans, or simply having illiquid existing assets that can't easily be converted to cash for investment. The firm has valuable projects, potentially great projects, but just insufficient cash or access to external funds to pursue them all. And the paper makes a key distinction by pointing out that many foundational studies focusing on financial constraints, think Kaplan and Zingales in '97 or Lamont et al., In 2001, they often explicitly exclude distressed firms from their samples.
Oh, okay. How do they do that?
Well, they might do it by looking at specific subsets of companies, for example, focusing only on manufacturing firms that show positive real sales growth. This careful sampling helps ensure that what they are truly measuring is the constraint on growth and investment, not an existing state of, financial deterioration or distress.
Okay, so that's financial constraint, a barrier to reaching full potential, limited opportunity. What about financial distress then? Where does that fit into the picture?
Right. So, in contrast, financial distress, according to researchers like Ruck back in 1990 and, standard corporate finance textbooks like Ross, Westerfield, and Jaffin, it describes a much more acute situation, one where cash flow is insufficient to cover current obligations. This is the crisis and survival we touched on earlier. This isn't about missed opportunities anymore. It's about, well, existential threats.
So a company in distress is really fighting for its life, whereas a constrained company is maybe fighting more for growth.
That's a perfect way to put it, yeah. Examples of distress would include failing to pay suppliers, or maybe employees, or facing potential damages from litigation that the firm just cannot cover, or critically, missing debt principal or interest payments, which lead straight to default.
Right. The really bad stuff.
Exactly. The impact of financial distress is typically associated with negative average stock returns. Firms in distress are often perceived as being on a downward spiral, and their stock performance usually reflects that decline. So while these concepts are undoubtedly correlated in the real world, a financially constrained firm could eventually become distressed if it can't overcome its limitations and opportunities keep slipping away.
Makes sense.
They are fundamentally different things. Think of financial constraints as a limitation on a firm's potential for optimal growth, and financial distress as an immediate crisis in its survival. And this paper, crucially, focuses on the former. It uses what it calls collateral constraints to capture this aspect, rather than modeling defaultable bonds directly. That would be more the domain of financial distress and the risk of default.
Got it. So the focus is squarely on the limitation, not the potential collapse. That's a really important setup.
It's paramount to their findings, absolutely.
Okay, with that vital distinction between constraint and distress firmly in our minds, we can now venture into the very heart of their ingenious work, the model itself. And trust me, it's quite the blueprint they constructed to understand these dynamics. This wasn't just a simple analysis of existing data. Livdan, Saprissa, and Zhang built an entire theoretical economy from the ground up, integrating various elements of firm behavior and financing. It really feels like a marvel of financial engineering and a significant step forward in our understanding.
Absolutely. The foundation of their model is an extension of a standard neoclassical investment framework. This framework is essential because it helps us understand how firms make their core investment decisions, how much capital to acquire, when to expand, things like that. The real genius here is how they integrated rich debt dynamics into this asset pricing context. This is something that was largely missing in previous literature, which often assumed maybe all equity financing or much simpler debt structures, which just isn't how companies operate in the real world, right?
Right. Reality is much messier. So they're taking established ideas and layering on more complexity to make it more realistic.
Exactly. Their work stands on the shoulders of giants, as they say. It draws key inspirations from existing research. For instance, the dynamic asset pricing aspects build upon earlier work by Lu Zhang himself in 2005. While the dynamic capital structure elements, particularly how firms decide on their mix of debt and equity, are inspired by Hennessy and Whitehead's 2005 work. So yeah, it's not starting from scratch, it's an evolution, carefully building upon and expanding established theories to address a new problem. Within this theoretical economy they built, the firms operate in a dynamic environment, constantly reacting to changes. They face two primary types of uncertainty, or shocks as they call them. First, there are aggregate productivity shocks. Think of these as economy-wide ups and downs, periods of boom or recession that affect all firms, maybe to varying degrees. This is the fundamental source of what we call systematic risk. The risk inherent to the entire market, the stuff you can't diversify away.
Okay, the big picture stuff.
All right. Second, firms also encounter firm-specific productivity shocks. These are unique to each company, maybe an innovation they develop or a supply chain disruption they face, or perhaps a new competitor emerges. These shocks create firm heterogeneity, meaning companies differ from one another in their profitability and growth potential at any given moment. Both types of shocks directly impact a firm's output and profitability, making their environment unpredictable.
So they're dealing with both the big picture economic forces and their own unique company challenges. Makes sense. What about how they actually produce things in this model?
Right, on the production side, the model incorporates several realistic features. Production exhibits what economists call decreasing returns to scale. This simply means that as a firm tries to grow larger and larger, adding more and more capital, the efficiency of each new unit of capital might start to diminish.
So bigger isn't always proportionally better?
Not necessarily, exactly. It's not always a linear path to endless growth. They also included basic fixed costs of operation. These are costs a firm has to incur every period. Think rent or administrative salaries, regardless of its output. These impact its baseline profitability. And crucially, for understanding flexibility, or perhaps more accurately, inflexibility, they included really significant asymmetric adjustment costs for capital.
Asymmetric, meaning?
Meaning it's much more expensive and difficult for firms to cut capital, to shrink their operations, than it is for them to expand it. Imagine a factory full of specialized machinery. It's relatively easy to buy more, but it can be very hard and costly to sell it off quickly without taking a big loss.
Ah, okay. That makes a lot of sense. It's much easier to step on the gas than to slam on the brakes, especially with big physical assets.
Precisely. This concept of costly reversibility is key to how firms respond to economic shocks and is fundamental to the inflexibility mechanism we'll discuss in detail later. It makes firms inherently somewhat rigid.
Okay, so they're a bit rigid. Now, how do these firms finance all this in the model? What are their options for getting cash?
Okay, let's turn to how these firms finance their operations and investments within the model. They have three main options, each with its own characteristics and, importantly, frictions, mirroring the real world. First, firms can use retained earnings, basically saving cash internally from their profits. However, there's a critical catch here. The interest rate they earn on these savings is strictly lower than the interest rate they have to pay when they borrow.
Why would that be? Why wouldn't saving be as good as borrowing? Seems odd.
Good question. This difference, or wedge as they call it, captures real-world frictions. It could be things like the tax disadvantages of holding excessive cash for long periods, as highlighted by researchers like Graham back in 2000, or simply market imbalances, where maybe an excess supply of loanable funds drives down the saving rate below the borrowing rate, as Cooley and Quadrini discussed in 2001. Essentially, there are costs or disadvantages to holding on to cash. It's not always the most efficient use of funds if there are better investment opportunities out there. This incentivizes firms to either distribute cash or invest it, rather than just hoarding it excessively.
Okay, so hoarding cash isn't free. What's option two?
Second, firms can utilize debt. The model simplifies this by focusing on single-period debt. Now, crucially, within this theoretical construct, all corporate debts are considered riskless.
Riskless. But we're talking about constrained firms. That sounds counterintuitive. How can their debt be riskless?
Well, it sounds strange, but it's because of the collateral constraints we're about to dive into. These constraints are designed within the model such that lenders are always guaranteed full repayment. So the interest rate on this debt simply equals the risk-free rate, at least in the model's design. This simplification allows them to isolate the impact of the constraint itself, rather than confusing it with the risk of outright default.
Ah, I see. It's a way to keep the focus narrow and clear. Okay. What's the third option?
The third financing option is external equity, meaning issuing new shares to investors. But this too comes with costs, flotation costs. These costs are structured in two parts. A fixed component for setting up an issuance, think lawyers, bankers, filing fees, and a convex component that scales with the amount raised.
Convex meaning?
Meaning larger issuances become proportionally more expensive. It's not just a flat percentage. The model even allows for these costs to be countercyclical.
Countercyclical, so higher costs when the economy is bad.
Exactly. Implying that equity issuance costs can be higher during bad economic times, which is consistent with empirical observations, like those by Kovas and Denhan in 2007. It's harder and more expensive to sell shares when the market is down.
So even raising money from shareholders isn't free. That makes sense. There are always bankers and lawyers taking a cut.
Exactly. And the importance of these flotation costs cannot be overstated within the model. If issuing equity were completely costless, firms would always just raise equity whenever needed. And if that were the case, the collateral constraints on debt would never actually bind. Firms would just issue equity instead of being constrained by debt limits.
Okay. So the equity costs are essential to make the debt constraints actually matter.
Absolutely. They are essential for the model to behave realistically and for financial constraints to have a meaningful impact on firm behavior. And this brings us to what I consider the absolute heart of the matter for this paper, the collateral constraints. This mechanism is the linchpin of the model's definition of financial constraints. It states that the liquidation value of capital net of depreciation must be greater than or equal to the promised debt payment for the next period.
Okay, break that down. Liquidation value. So what the assets are worth if sold off quickly.
Exactly. It's the direct limit on how much a firm can borrow. It's literally saying you can only borrow up to what your assets are reliably worth if you had to sell them tomorrow to cover your debt.
So banks won't lend you more than your assets are worth if they have to seize and sell them in a pinch. And they assume those assets might not fetch full price, right?
Precisely. The model further specifies that if a firm had to liquidate its assets to repay debt, they wouldn't get their full value. Capital can only be sold at a depressed price, meaning a portion is lost as liquidation costs. For example, the benchmark calibration in the paper uses 15% liquidation costs, which aligns pretty well with empirical studies like Altman's 1984 work on distressed sales.
Yeah.
And to make this even more realistic, the model also allows for a scenario where these liquidation costs are higher and thus the liquidation value is lower during recessions.
Ouch. So your borrowing power shrinks just when things get tough.
Exactly. It means a firm's debt capacity can actually decrease in bad economic times, amplifying the effects of financial constraints precisely when flexibility might be most needed. These collateral constraints, therefore, directly limit how much a firm can borrow, forming the core friction that defines financial constraint in their framework. Finally, the model introduces a brilliant and really insightful concept: the shadow price of new debt. Now, this isn't something you'll find on a company's balance sheet. It's a theoretical measure derived directly from the model's optimization problem. Think of it as maybe an internal speedometer for a firm's financial tightness.
A speedometer for financial tightness. I like that. What does that mean in practical terms? How does it work?
It's essentially a measure of just how much an extra dollar of debt would be worth to a firm right now. If this shadow price is high, it means the firm is severely constrained. And getting even a little bit more debt is incredibly valuable to them because they're facing a severe shortage of external funds.
So a high reading means they're desperate for cash.
Pretty much. It quantifies the marginal benefit of being able to obtain new debt, which saves the firm from incurring those costly equity flotation fees we just talked about, against the marginal cost of repaying that debt in the future, which might force future, potentially costly equity issuance down the road. So this shadow price is a precise internal gauge of a firm's financial tightness and its cost of accessing capital. It's the model's way of telling us how desperate a firm is for that next dollar of external funding.
Okay, we've carefully constructed the theoretical firm. We understand its environment, its production, its financing options, especially those crucial collateral constraints and their shadow price, that tightness speedometer. This is where it all comes together. And for me, this is the real turning point, the core insight of the paper. How do all these financial gears and cogs actually translate into a firm being riskier or offering higher returns? It all comes down to a powerful concept they call the inflexibility mechanism.
Precisely. The core insight here revolves around a firm's ability, or perhaps its inability, to be flexible in its investment decisions,
Yeah.
particularly in response to those economy-wide aggregate economic shocks we mentioned earlier. Let's start by considering a healthy, unconstrained production economy. Imagine a firm that has ample access to capital. In such an environment, firms possess a high degree of flexibility. When a positive aggregate shock hits, say, the economy experiences a boom, or there's a surge in demand for their products. These firms can choose to increase their investments because they anticipate future growth and higher profitability. They can seize the moment.
So they see a good opportunity, they have the cash or can easily get it, and they invest for the future. Makes sense.
Exactly. Now, what this means in terms of dividends is fascinating. Their dividends won't necessarily increase unit for unit with their cash flows. Instead, a significant portion of that extra cash flow from the boom is reinvested back into the business.
Wow.
This reinvestment acts as a crucial buffer, effectively smoothing out their dividend streams to shareholders over time. By doing this, the firm's dividends cover less directly and intensely with the overall business cycle, making their payouts more stable. And this stability ultimately decreases its risk from the perspective of an investor.
Right, like a company with a strong savings account. Unexpected profits come in, they put some aside for the future rather than paying it all out right away, more stable payouts.
That's a good way to think about it. They can use investment to buffer those payouts. This is what flexible, unconstrained firms naturally do. Now, here's where the collateral constraints come into play and why they are so critical to the inflexibility mechanism. The critical insight of the paper is that collateral constraints work against this very dividend smoothing mechanism. By preventing firms from financing all their desired investments simply because they can't borrow enough against their collateral, regardless of how good the investment opportunities might look. These constraints directly limit their flexibility.
Ah, so even if there's a boom and great opportunities knocking, the financially constrained firm can't fully take advantage of them. They're stuck.
Precisely. If a financially constrained firm cannot invest as much as it wants during a boom because its borrowing limits are binding,
Uh-huh.
then more of its cash flow is effectively forced out as dividends. It simply has fewer avenues to internally buffer its earnings through productive reinvestment.
So the cash has nowhere else to go, essentially.
Right. Its dividends will then cover more directly and intentionally with the business cycle because there's less reinvestment happening to smooth things out. They're forced to pay out a lumpier, more volatile dividend stream. The outcome is clear. A firm with a high shadow price of new debt, meaning its financial constraints are very binding, is inherently more inflexible. This inflexibility causes its dividends to be more volatile and more correlated with economic ups and downs. Therefore, such firms are riskier because their cash flows to shareholders are less predictable and more tied to systematic economic movements. And in an efficient market, higher risk must be compensated with higher expected returns to attract investors.
Okay, hold on. Let me make sure I've got this.
Sure.
It sounds almost counterintuitive for a traditional investor. You'd normally think a firm that can't invest due to constraints would be less risky because they're not taking on new, maybe uncertain projects. But what you're saying is precisely because they can't make those smart buffering investments to smooth things out, their shareholders are left holding a much wilder, more volatile ride of cash flows.
That's the aha moment right there, yes.
Wow, that's a huge shift in perspective. It's not the investments themselves that add risk, but the inability to make them strategically.
That's the core of the inflexibility mechanism. It flips the script. It's the lack of strategic flexibility that drives up the risk. This mechanism is similar, in a way, to how high capital adjustment costs can also restrict investment flexibility, which Lu Zhang explored in his 2005 paper. But here the inflexibility specifically stems from the collateral constraints on debt, making it a new, distinct channel that this paper uniquely highlights.
Okay, so the model predicts these financially constrained firms are inherently riskier and therefore should offer higher expected returns. That's a powerful revelation. But who are these firms in the real world? Does the model give us a clear profile of the most constrained and therefore potentially highest returning companies that we should be looking for?
Yes, absolutely. The model provides clear characteristics for firms that exhibit higher shadow prices. Remember, that means they are more financially constrained. And this is confirmed through their qualitative analysis and extensive simulations in the paper. You can actually see these relationships visually depicted in their figures, like Figure 2 and Figure 3. These figures illustrate how certain firm characteristics tend to lead to higher shadow prices, greater risk, and ultimately higher returns within the model's framework. First, the model indicates that firms with a smaller capital stock, which often corresponds to smaller firm size in the real world, tend to be more constrained.
Okay, smaller firms. Why?
Well, the intuition here is pretty straightforward. Smaller firms generally have lower internal funds available for investment, just less cash generated internally. At the same time, because of that decreasing returns to scale in their production technology we mentioned, they often have a very high demand for additional efficient investment to grow and become more efficient.
So low cash, high need.
Exactly. This combination of low internal funds and high investment demand makes their borrowing constraints more likely to bind. They have ambitious plans, but limited means. It's essential.
Okay, so smaller companies are more likely to hit that borrowing ceiling even if they have great ideas. Got it. What else?
Second, firms with lower firm-specific productivity, which essentially means they are less profitable currently, are shown to be more constrained.
Less profitable. Okay, that seems intuitive. They just have less money.
Well,
Mm.
yes, but it's a bit more nuanced than that. You might initially think a positive productivity shock, something good happening, just that firm increases its cash flows, which should reduce its need to borrow and make
Yeah.
it less constrained.
More cash, less constraint.
But the model shows that while a positive shock does raise cash flows, it also significantly increases the firm's desired investments. Because that firm's specific productivity is somewhat persistent, they see a path to higher profitability and want to invest heavily to capture it.
Ah, so they just want to invest even more because they've seen a glimpse of what's possible and they're starting from a lower base.
Precisely. Quantitatively, the model shows the negative cash flow effect dominates for these less profitable firms. Their lower baseline profitability means they have fewer internal resources to begin with. This makes them more dependent on external financing, and thus more likely to be constrained. Think of it this way. A less profitable firm is often living maybe a bit more hand-to-mouth. Even a small bump in productivity makes them want to invest a lot more because they have so much potential to improve. But that desire quickly outstrips the small increase in cash they just received. They're still critically short of funds compared to their ideal investment level, making their borrowing limits bind even tighter. They have great ambitions but insufficient initial capital to scale them effectively.
Okay, that makes sense. It's the gap between desire and current resources. What's the third characteristic?
Third, firms with higher current period debt are also more constrained. This one probably makes the most immediate, intuitive sense.
Yeah, more debt already means less room to borrow more.
Exactly. Firms already burdened with a substantial amount of debt simply have fewer internal funds left over to finance new investments after making their scheduled repayments. This higher debt load directly impinges on their ability to raise additional financing, pushing them more frequently against their collateral constraints. They are, in a sense, already kind of maxed out.
Sounds like me trying to get another credit card when I'm already carrying a balance.
A perfect analogy, yes. Beyond these core characteristics derived from the model structure, the paper also confirms several empirical signposts that help identify these constrained firms in the real world. And these are often what real-world analysts look for. These include firms that typically have lower cash flow to assets ratios, higher debt to assets ratios, lower sales and sales growth figures, lower dividends to assets ratios.
Wait, lower dividends? I thought you said they pay out more dividends because they can't invest.
Good catch. It's a bit subtle. Their dividends are more volatile and cover more with cash flow, but the level of dividends relative to assets might still be low because overall profitability might be lower, or they might be hoarding whatever little cash they can, even while being constrained at the margin for new investment. It's complex.
Okay, got it. So lower dividends to assets. What else?
Also, lower liquid assets or cash to assets ratios, and surprisingly perhaps, often higher Tobin's Q values.
A higher Tobin's Q. That's interesting because that usually suggests good growth opportunities, right?
Exactly. It's a sign of a high value placed on the firm's growth opportunities relative to the cost of replacing its assets.
But in this context, it would mean good opportunities that they can't fund because of the constraints.
Precisely. It's potential they can't fully capitalize on due to lack of financing. These are the real-world indicators that practitioners and researchers use to proxy for financial constraints. And the model provides a strong theoretical underpinning for why these indicators are relevant signals of that underlying tightness.
Okay, this theoretical model is really elegant, and the insights we've discussed about the inflexibility mechanism are profound. It's definitely changing how I think about the dynamics of risk and return. But, you know, the real test for any theoretical masterpiece is always what happens when we throw data at it. Or in this case, simulated data. How did the researchers move from this elegant theory on paper to actually seeing if it holds water in a simulated environment? Did it work?
Indeed, the quantitative validation is where the rubber meets the road, as they say.
Right.
And they didn't just propose a theory. They meticulously tuned every knob and dial in their model. They made sure each parameter reflected real-world observations from the empirical literature as closely as possible. This involved setting values for things like the monthly capital depreciation rate, the persistence and volatility of those aggregate productivity shocks, those asymmetric capital adjustment costs we talked about earlier.
Right, the ones making it harder to shrink than grow.
Exactly. Remember, based on estimates, it might be 10 times harder or take much longer to reduce capital than to expand it, reflecting how inflexible real-world assets like factories can be. They also calibrated fixed production costs and even the equity flotation costs and those liquidation costs for collateral. All this was carefully chosen to match what we observe in actual markets. The whole point was to ensure the model's aggregate market behavior mirrored reality as closely as possible, providing a robust foundation for their simulations.
So they basically built a highly detailed simulated mini economy in their computer.
Precisely. And the scope of their simulation was truly massive. They generated 100 artificial panels, each containing 3,000 firms, simulated over a span of 480 months, which is 40 years of monthly data.
Wow, that's a lot of virtual companies and data points.
It's an enormous amount of synthetic market data, yes. This allowed them to perform empirical tests on this simulated data, just as a financial researcher would on real-world market observations. It's essentially a controlled laboratory for financial economics, where they could isolate the effects of financial constraints without all the noise and confounding variables you find in the real world. Their first step in analyzing this simulated data was through what are called univariate sorts, the results of which are shown clearly in Table 2 in their paper. Here, they sorted firms only based on their simulated shadow price of new debt. Remember, that's their precise internal speedometer of financial constraint. They sorted them into 10 deciles, from the least constrained, lowest shadow price, to the most constrained, highest shadow price. They essentially lined up all 3,000 firms from financially loose to financially tight.
Okay. And what did that lineup reveal? Did their prediction of higher returns for constrained firms actually hold up in the simulation?
The results were clear, robust, and pretty fascinating. The model showed a distinctly positive and monotonic relationship,
Monotonic meaning.
meaning it consistently went up. As firms became more constrained, moving from the lowest shadow price decile to the highest, their average monthly stock returns consistently increased. To give you some concrete numbers from their benchmark model, the least constrained firms, those in the bottom decile, earn an average of 0.33% per month, while the most constrained firms, way up in the highest decile, earned 0.67% per month.
That's a significant difference, more than double, actually. A whole 0.34% per month higher for the most constrained.
It is indeed. This resulted in a statistically significant average return spread of 0.34% per month between the most and least constrained deciles, with a strong t-statistic of 3.54, meaning it's very unlikely to be due to chance. And importantly, this positive relation held across various comparative static experiments where they tweak model parameters, demonstrating its robustness and the fundamental nature of the inflexibility mechanism they identified. So in their controlled laboratory environment, the model clearly says more constrained, more returns. End of story, right?
Well, it seems like it, but this brings us back to that initial puzzle you mentioned, doesn't it? The fact that real-world data sometimes showed mixed results, especially when researchers controlled for other factors like firm size. Does the model account for that empirical nuance, or does it contradict it? Because the simulation seems so clear-cut.
You've hit on exactly the next crucial step. That's where the multivariate sorts and regressions really add a layer of critical understanding, as detailed in their tables 3 and 4. Remember, previous empirical work like Lamont et al. 2001 and Whited and Wu 2006 found that once you control for firm size, the return difference between constrained and unconstrained firms often becomes statistically insignificant.
Right, that was the puzzle. If constraints drive risk, why did the signal disappear when size was included?
Exactly. The LSZ model beautifully explains this apparent contradiction, and is really a testament to its power. When they performed two-way sorts in their simulations, first sorting by market capitalization, a common proxy for firm size, and then sorting by the shadow price within each size group, the average return spread for the financial constraints factor, they call it the FC factor, in their simulations was only 0.12% per month, with an insignificant t-statistic of just 1.11.
Wow, so the big spread vanished once they accounted for size, even in their own simulation.
It shrunk dramatically and became statistically insignificant, yes. And this outcome is remarkably consistent with the insignificant findings reported in the real-world data by Lamont et al. And Whited and Wu. For comparison, Lamont et al. Reported a spread of negative 0.13%, with a t-stat of negative 1.15, and Whited and Wu found 0.18% with a t-stat of 0.95, both statistically insignificant, just like the model predicted when controlling for size.
Okay, that's fascinating. So the model doesn't contradict those earlier findings, it actually explains them. But why? Why does size mask the effect of financial constraints in these multivariate tests?
They further solidified this point using Fuma-Macbeth regressions, which is a standard statistical tool in finance for looking at cross-sectional returns. While the shadow price was indeed significant in predicting returns when considered alone in univariate regressions, once they added common control variables like firm size, specifically the logarithm of market value of equity and book-to-market equity into the regression, the shadow price's coefficient, its slope, became insignificant and sometimes even negative.
So the direct measure of constraint lost its predictive power when these other common factors were present.
Right. But this isn't a contradiction. It points to a deeper understanding of the financial landscape. The model reveals that risk, expected returns, the shadow price of debt, firm size, and book-to-market equity are all jointly determined by the firm's underlying fundamental state variables, meaning things like its current capital stock, its firm-specific productivity level, its current debt levels, and the state of the overall aggregate economy. These are the deep drivers. The shadow price does contain valuable information about a firm's risk and expected returns, absolutely. But that information is not entirely independent of what's already captured by observing a firm's size and its book-to-market ratio.
I think I get it. So size and book to market aren't just arbitrary control variables people throw in. They're actually picking up on some of the same fundamental drivers of risk and constraint that the shadow price measures, just maybe indirectly.
Precisely. Think about it this way. Trying to predict someone's overall health using, say, a blood pressure reading provides useful information, right?
Sure.
But that blood pressure reading isn't wholly independent of their diet and exercise habits, which are maybe deeper, more fundamental inputs to their health. The blood pressure is often an outcome or a reflection of those deeper inputs.
Okay, that makes sense.
Similarly, firm size and book to market are often outcomes or reflections of a firm's underlying financial health, its investment opportunities, its profitability, and its access to capital. All these indicators are interconnected, providing different lenses, different perspectives on the same underlying economic reality of the firm. So, while size is a powerful proxy for some aspects of a firm's state, it can also absorb the explanatory power of more direct, but perhaps noisier or less easily observable, measures of constraint like the shadow price, especially in these kinds of statistical tests.
This deep dive has offered some really incredible insights into how financial constraints work in theory and how they play out in these carefully constructed simulations. But what about the practical implications for investors and financial professionals out there in the real world? How does this sophisticated model help us evaluate the empirical tools, the proxies, that financial researchers actually use today to try and measure these constraints? And maybe even more broadly, does it shed new light on long-standing puzzles, like the complex relationship between a company's debt levels, its leverage, and its stock returns?
Excellent questions. And the paper definitely delves into these practical applications. One of the main challenges, as we've touched on, for researchers in the real world, is that the true shadow price of new debt, that precise measure of financial constraint from the model, is, by its very nature, unobservable.
Right. You can't just look it up on a Bloomberg terminal.
Exactly. We can't just pull it from a company's financial statements or easily calculate it. So researchers have to rely on observable characteristics to proxy for these financial constraints, trying to infer financial tightness from publicly available data.
Right. They're trying to measure that financial tightness speedometer indirectly using clues from the company's stats.
Precisely. The beauty of having a robust theoretical model like this one is that LSZ could use it as a kind of natural laboratory to test how well two popular empirical proxies actually captured their model's true shadow price. They examined the Whited and Wu WW index, which is based on characteristics like cash flow to assets, debt to assets, sales growth, and dividend payments, things you can observe. The model confirmed that these characteristics do indeed correlate with financial constraints in the expected ways. For example, lower cash flow, higher debt, and lower sales generally indicated a more constrained firm within their simulated world, just as Whited and Wu proposed based on empirical data.
Okay, so the WW index seemed consistent with the model's logic. What about the other one?
They also looked at the Kaplan and Zingali's KZ index, which uses a slightly different set of characteristics. Cash flow to assets, debt to assets, dividends to assets, liquid assets or cash to assets, and Tobin's Q. Again, the model showed that these characteristics also correlated appropriately with the shadow price, consistent with the empirical evidence that led Kaplan and Zingali's to create their index. However, the critical finding comes from what they call the horse race, essentially, running statistical regressions where they tried to predict the model's true shadow price using these empirical index values.
Okay, pitting the proxies against the real thing, so to speak.
Exactly. And while both the KZ and WW indices were positively correlated with the true shadow price, as expected, the R-squared values, which measure how much variation in the shadow price these proxies actually explained, were universally low.
Universally low. How low?
The highest R-squared they found was just 11.74%.
Wow. So even the best widely used empirical proxies are only explaining, what, less than 12% of the actual financial constraint a firm faces, at least according to this model.
That's a sobering thought for researchers and investors, trying to identify constrained firms in the real world using these tools.
It is a critical and perhaps sobering finding, yes. It means that these widely used empirical proxies leave substantial variation in the true shadow price unexplained. In essence, it suggests we're still not very good at empirically measuring financial constraints accurately in the real world. While these proxies are useful and point in the right direction, they're far from perfect measures of that underlying tightness. Though it's worth noting that within their model, the WW index generally performed a bit better than the KZ index, explaining slightly more the variation in the shadow price.
Interesting. So maybe one proxy is slightly better than the other, but neither is great. That's what their model suggests, yeah. It points towards continuing the search for better, more accurate ways to measure financial constraints empirically. Beyond proxies, the model also offers fascinating insights into the cyclical nature of constraints and leverage, how these things change with the overall economy. They found that the shadow price of new debt, when averaged across all firms in their simulation, was weakly procyclical.
Pro-cyclical, meaning constraints get tighter when the economy is good. That seems backward.
Well, weakly procyclical, meaning it tended to rise just slightly during economic expansions, showing a correlation of only around 0.20 with aggregate productivity. What's even more nuanced is that this correlation became almost acyclical, essentially flat, no relationship with the cycle when firms had more affordable equity financing options available in the model.
That's really interesting. It seems to challenge some conventional thinking, I imagine. Why would financial constraints not be more binding during a downturn when things are generally tough for companies?
Exactly. This finding does challenge some earlier models that might have suggested a strongly countercyclical shadow price, where constraints tighten significantly during recessions. This paper implies that incorporating richer debt and equity dynamics fundamentally changes our understanding of how financial constraints interact with business cycles. When equity is relatively cheap to issue, firms have more options. So the debt constraint, specifically the collateral constraint, becomes less universally binding in downturns, perhaps because they can shift towards issuing equity if needed.
I see. The availability of equity finance acts as a safety valve.
Potentially, yes. Now, looking at leverage itself, the model predicts that aggregate market leverage, which is total debt divided by total market value of equity, is strongly countercyclical. It shows a strong negative correlation, as low as negative 0.901 with aggregate productivity.
Okay, so market leverage goes up when the economy goes down. Why?
This means firms appear more leveraged during economic downturns, primarily because their market value of equity shrinks much faster and more dramatically than their level of debt does when times get tough. Stock prices fall hard in recessions. And this prediction is actually consistent with real-world empirical evidence documented by researchers like Korosik and Levy back in 2003.
Okay, so the model matches that real-world observation. What about other measures of leverage?
Well, here's another important distinction. Aggregate book leverage, which is total debt divided by total book value of capital or assets, is predicted by the model to be weakly procyclical. It shows correlations around 0.12 to 0.25 with aggregate productivity, so it moves slightly with the economy.
That's a powerful distinction, the difference between market leverage and book leverage and how they reflect economic cycles. Why would one be strongly counter-cyclical market and the other weakly pro-cyclical book?
This intriguing divergence occurs because the market value of equity is inherently much more volatile and procyclical than the book value of equity or capital. Market values are forward-looking. They incorporate the effect of countercyclical aggregate discount rates embedded in the model's complex asset pricing mechanisms.
Counter-cyclical discount rates,
Meaning, the rate used to value future earnings tends to be lower in good times, making future earnings seem more valuable today, and higher in bad times, making future earnings seem less valuable today. This amplifies the swings in market equity values compared to the more stable book values, which are based on historical costs. This amplification effect then causes market leverage, debt market equity, to appear strongly countercyclical, even if book leverage, debt book value, moves differently or even slightly procyclically. It really shows how the market's perception of value is far more dynamic than traditional accounting figures.
That's a crucial nuance for any investor looking at leverage ratios. They tell different stories. Leverage is a term every investor knows, but this paper really gives us a fresh, more nuanced perspective, going beyond the simple textbook definition we're often taught.
Absolutely. And this leads directly to how the model refines our understanding of the leverage-return relationship. The standard leverage hypothesis, the one often taught in corporate finance textbooks like Greenblatt and Titman, 2001, basically states that all else being equal, higher market leverage, a higher debt-to-equity ratio, implies higher equity risk for shareholders, usually measured by equity beta, and therefore higher leverage should lead to higher expected equity returns.
Right. More debt, more risk for shareholders, higher required return. Pretty standard.
Exactly. The key assumption in this traditional view, though, is that the asset beta, which represents the risk of the firm's underlying assets before considering its financing structure, is fixed, regardless of the capital structure. It posits a simple, linear relationship. More debt just magnifies the existing asset risk onto the equity holders. However, the LSC model's inflexibility mechanism adds a crucial refining layer to this standard story. It shows that the asset beta itself actually increases with leverage.
Wait, the risk of the underlying assets increases with leverage. How does that work? I thought asset risk was independent of financing.
That's the standard assumption, but this model challenges it through the inflexibility channel. The intuition is this. More highly levered firms are, by definition, burdened with more existing debt and must prioritize making those repayments. This makes them more likely to face binding collateral constraints, precisely the financial constraints we've been discussing all along. These constraints, in turn, reduce their flexibility to adjust capital investments strategically to smooth dividends, as we explained with the inflexibility mechanism.
Ah, okay. So it's not just that the debt makes the existing asset risk appear larger to shareholders, it's that the debt triggers those constraints, which then makes the underlying business itself, the actual assets, behave more erratically and become riskier.
Exactly. Consequently, their underlying assets become inherently riskier because the firm's ability to generate stable cash flows to shareholders is compromised by this constraint-induced inflexibility. Therefore, the model predicts a convex relationship between market leverage and expected returns, not a simple linear one.
Convex meaning it curves upwards.
Yes, the risk doesn't just increase proportionally with leverage, it accelerates as leverage grows. The impact of adding more debt gets worse and worse, especially for less productive firms where other sources of inflexibility, like those asymmetric adjustment costs for capital, are also more prominent. This convex relationship is visually demonstrated in Figure 4 of their paper.
So risk ramps up faster than linearly as debt increases.
That's the prediction. And they quantitatively tested this using their simulations, looking at Fama-Macbeth regressions again, Table 7. While market leverage alone did significantly predict stock returns in their simulated data, as the standard hypothesis would suggest, when asset beta was also included in the regressions as a control variable, the leverage slopes became much smaller and, importantly, statistically insignificant. Meanwhile, the asset beta slopes remained significantly positive and large.
Wow. So the asset risk explains the return difference, and once you account for that, leverage itself doesn't add much more explanation.
That's what the simulation strongly suggests. It powerfully demonstrates that the core driver isn't just leverage itself in isolation, but rather how leverage interacts with financial constraints to make a firm's underlying assets inherently riskier, increasing asset beta. It's a new, deeper understanding of how capital structure impacts risk and returns, fundamentally linking it back to the operational flexibility, or lack thereof, of the firm. #outro.
Wow, what a deep dive indeed. We started with a perplexing puzzle in the financial literature, those conflicting findings about constrained firms and their returns. It felt like a real head-scratcher. And through the rigorous and frankly quite innovative framework of Livdon, Saprissa, and Zhang, we've gained a truly profound understanding. It's not just about identifying what financial constraints are, but really digging into how they fundamentally alter a firm's risk profile, and by extension, its expected stock returns in ways we might not have initially thought.
Yeah, the core takeaway, I think, is crystal clear from their work. Financially constrained firms are inherently riskier, and therefore, in an efficient market, they must offer higher expected returns to compensate investors for bearing that added risk. Now, as we saw in the simulations and discussed with the empirical findings, this relationship isn't always directly observable in simple statistical tests. That's also because other factors, like firm size and book-to-market ratio, capture similar underlying information about a firm's state and its fundamental drivers. But the driving force, the underlying economic mechanism, seems to be that inflexibility mechanism caused by collateral constraints. That's what prevents firms from effectively smoothing out their dividend streams during economic fluctuations, making them riskier investments.
And this isn't just academic theory for theory's sake, right? It has real practical implications for anyone looking at companies, whether you're an investor, an analyst, or just curious about finance. It challenges how we perceive risk in companies, especially those with high debt levels or seemingly limited access to capital. It highlights that a firm's ability to adapt, to invest strategically when opportunities arise, and to access flexible financing is actually a powerful buffer against market volatility. It's a key determinant of its long-term risk and return characteristics. It really underscores the value of, well, agility for a company in the face of economic change.
Absolutely. And the paper, like all great research, leaves us with compelling avenues for future work, pushing the boundaries of our understanding even further. One key area, which they acknowledge, is the potential integration of defaultable bonds into these sophisticated neoclassical investment frameworks.
Defaultable bonds, meaning allowing for the possibility that the company might actually fail to repay its debt?
It's exactly. Bringing in the risk of actual default, which would allow us to fully bridge the conceptual gap between financial constraints, which this paper masterfully addresses, and financial distress, which we defined earlier as the inability to meet obligations. Imagine having a single, unified model that could seamlessly move from describing a firm that's struggling to invest optimally because it's constrained, all the way to describing one that's truly on the brink of bankruptcy, facing distress.
That would be a huge step, a real game changer, connecting those two distinct definitions we started with right at the beginning.
Exactly. This would be a crucial step, I think, in finally answering a deeper puzzle that has long perplexed researchers in finance. Why do more distressed firms empirically tend to earn lower average stock returns? Their stocks perform poorly, but simultaneously exhibit higher credit spreads on their debt than less distressed firms. There's this weird disconnect between their stock and bond market signals.
That is a puzzle. Low stock returns, but high bond risk premiums.
Right. Understanding these subtle yet profound distinctions, maybe through a model that incorporates both constraints and distress, could completely reshape our perception of corporate health, market efficiency, and the true cost of risk that different types of companies embody. It's really about building a more complete, more unified picture of how firms behave and how they're valued across the entire spectrum of financial health, from slightly constrained all the way to deeply distressed.
That's a truly thought-provoking challenge for future research and a great place to leave it for today. It really makes you wonder, how might a deeper understanding of these subtle differences between financial constraint and financial distress change how you evaluate risky companies? And could refining that understanding even reshape our view of market efficiency itself? We hope this deep dive has given you plenty to think about and maybe sparked your own curiosity to explore further. Thank you for joining us on the Deep Dive.